welcome back to Turnkey Property Pros, the Investor Playbook. A lot of investors spend time thinking about what property to buy or what market to buy in, but far fewer spend enough time thinking about how to finance those investments. And that decision really shapes everything from your returns to how quickly you can scale. So today we have a guest who spent his career helping real estate investors answer exactly that question. Aaron Chapman has been lending since 1997. He's been an investor himself since 2001, and he's experienced everything imaginable in the market, including rebuilding his business from the ground up. He's got practical data from personal experience. Aaron's now the Executive VP of Investment Lending at North American Financial. Today, he's going to walk us through the two financing options most turnkey investors will encounter: conventional loans and DSCR loans. We'll talk about what each one of them are, when they make sense, and what it takes to actually qualify for those. So Aaron, welcome to the show. We're so glad to have you here. Before we jump into this episode.
I'm glad that's the case. A lot of times people, you wonder, are they glad to have you there? So thank you for the invite.
We're so happy to have you here. You're a great partner of ours, so we're excited to introduce you to everybody as well. Before we jump into the mechanics of loans, can you give us a quick intro of yourself, your background, and the type of investors you typically work with?
Background goes quite a ways back. Grew up in a rural town, cheated my ass off to get that C in high school. I had to engineer that because I did not like sitting and learning things I didn't think would practically apply. I was running cattle, 500 head of beef cattle per year. And then from there, I graduated early. Somehow that worked out. Went to work in the oil fields of Wyoming, then run heavy equipment, driving truck. And I found myself in the mines of northern New Mexico in 1997, which was the greatest job I've ever had. I'll still say that. Anytime you get to go several hundred feet underground and play with explosives and heavy equipment, that's a man's dream. And I enjoyed every bit of it. But the problem with that world is the markets shift very, very fast. And when it costs more to bring the ore to the surface than what you can sell it into the market because of what they want that particular material for, then they have to shut down those projects, lay everybody off till it makes sense to start working again. I had to go find work, and I decided to go back to what I knew, which is heavy equipment, driving truck, or welding, and I couldn't find a job anywhere. I kept getting this response of being overqualified. So I was at a point where I was completely financially destitute. I had an infant son. My wife was here in Arizona. I was back and forth between New Mexico and Arizona every 13 days, and I went to go looking for just a $10 an hour truck driving job just so I can pay the bills. The bills were small back then, right? The apartment rent was like $460 a month. Vastly different world back then. Well, I went again, applied for another job, and I got that same overqualified response. And as I'm leaving there, wiping tears from my eyes, a broken 23-year-old man, like, how do I do this when I've got this heavy responsibility? And as I'm driving away from that location with a coupon for free diapers, because I was overdrawn on my account, I couldn't afford diapers. My gas light comes on my truck. I'm like, another problem to deal with. I'm 20 minutes away from home. So I drove to the closest grocery store that had a gas station right there in the same parking lot. Pulled up to a pump. I said a quick prayer, hoping that my credit card would work, or my debit card at the time. I didn't have a credit card. Swiped it, and I got a decline. So I went rifling through my truck looking for lost change. I found a couple of coins. I locked the doors, and I started walking that parking lot for seemingly 2 hours to get enough change for 2 gallons of gas. Now, this is 1997. Gas was like 89 cents a gallon, and people still carried change. It was possible to accomplish this in a couple hours. Then as I paid for my gas, I went inside with that coupon with my one item I was buying, which was like diapers, and I had something for free. It was a little bit more of an additional insult on top of the day that I had. As I'm walking out of there with my head down, not making eye contact, I heard the worst thing I could have heard at that moment, and that was my own name. Somebody recognized me. We got to talking. He used to run the office where I ran heavy equipment. He said, let's go to dinner. So he took me to Red Lobster with a gift certificate from a client and introduced me to the mortgage industry. And I started as a telemarketer in December of 1997. Let's just say already going from underground work to surface work was miserable, but now going to a conference room to call blind numbers from a sheet was 1,000 times worse. But once I got 10 good referrals, I asked the boss if he'd let me work those referrals. He introduced me another loan originator, and that's how I started. They started teaching me how to take a loan application in December of 1997. From there, it's we learned the industry from a lot of kind of crazy some bitches. These guys were definitely interesting guys at the broker shop. You walk over to the to the soda machine. You push the out of order button, you get a Michelob for 50 cents. It was really an interesting office to work in. And then from there, the things shifted in 2001 after 9/11. I started my first investments after that, and it's been a wild ride ever since. 2008 was extremely wild. Whole other deep dive story. 2015, I had to start my business over again after I started really working with heavy investors, and then became number one in the United States for writing real estate investor loans in the conventional space. Number 7 in the United States for loans, period, in recent years, and now taking the opportunity to take over a division for a company and be an executive rather than just a regular loan officer or a branch manager. So pretty interesting career I've been able to experience.
That's a wild ride. That's amazing. Like shows,
Yeah.
shows your determination and the grit there, and probably relate to a lot of people that we talk to as well. That's great.
Well, grit and ass beatings, we can go for the whole thing just talking about that. Help real estate investors, so we don't want to hear all about Aaron Chapman and the scars I carry.
I think it's pretty impressive though, man. I mean, what you bring to the table, as you know, we're huge on education, and like we take an approach of education and, teaching as opposed to just talking about rental property investing and cash flow, right? We want the investor to be well-rounded, right? And so you bring that experience, and I know your phone calls. I know I've been on multiple webinars with you where you're such an educator and a teacher in the space, right? It's for you, it's not just about the sale. It's about what the hell are you doing a loan for, and how does the loan work for you, right? So, and sorry to walk on you there, Amber, but like I just think it's important to note that it's such a good you're like a good extension of our education, like the way that we approach working with investors, right? We're not just about high volume sales and getting it done. It's about, well, let's build a plan, a strategy. And such a big part of that strategizing is what type of loan are you using, right? Like what type of product are you using? And we've talked about this early on in the opening here about, what financing decisions are the best. Do we use conventional loans, or do we use non-recourse loans, or do we use, asset-based loans? What would you say for you, and Amber's got a good question here. We talk a lot about investors planning for and, buying, but from your seat, how often do investors come to the table with a financing strategy? Do they know what they're doing, or is there a lot of times where you are spending the majority of the time educating?
We're doing a lot of damage control, honestly, when it comes to most investors, because they're caught up in where do I find the deal? What's a good property to buy? What's my cash on cash return going to be? And like, oh, I've already signed a contract. I better figure out how to pay for this. So now they're operating in desperation because the clock is ticking. And so that's where we are now under the gun to try and figure out, okay, what is your financial structure like? What loan is going to be best for you? And how do we get you set up to be able to close? And you've got less than 30 days now. It's because you spent the first week of your contract time comparing lenders. And now the problem is people are comparing it off of price. If price was it, then you would just go to the internet and pray for the best. The problem is real estate investing is a much more intricate process when it comes to lending than just going to the internet and finding the cheapest rate and the cheapest price. That's one of the things I think is beneficial to my business, is that AI is going to be what it's going to be. And I know that there's institutions out there using AI to be the fastest and the cheapest and taking people out of the mix. But that doesn't work in the real estate investment world, which is great for me because it's such a complicated process. So what I encourage everybody who's considering getting into investing in real estate is don't go looking at properties yet. Don't consider areas. Start figuring out how are you going to pay for it, number one, and what things do you need to have in place to be successful as a business owner, because that's what they are. You're buying individual businesses. And how do you structure that properly? I'm big into, we absolutely need to go through the lending steps first, get the pre-qualification in place. And it's not just we're going to pull your credit and look at a pay stub scenario. It's do the full application. Let's figure out, do you want to do this with a DSCR or conventional? Each one's going to have different paperwork requirements. And we're going to get a pile of paperwork day one. And I get a very common response from somebody saying, do you really need all this for a pre-qual? Like, yeah, because if you ever talk to a lender and you spent 3 weeks doing all this work with him, and it's like, oh, this is an easy process. It's not taking much at all. And then you're supposed to close in 5 days, and he wants this and this and this and this and that paper. Call your accountant. Oh, do you need to get a hold of the IRS and get this for me? And all these things. And now you're under this massive gun. It's completely frustrating, and you don't even know if you got enough stuff yet, because he keeps asking questions. That's when the stakes are high. We gather all that when the stakes are very low and everybody's calm and nobody's frazzled. So we build a really good file, and then it's okay. What product are we going to look at? I highly encourage DSCR right now. When it comes to lending capability, DSCR and other things that are not your common Fannie Freddie conventional loans, they come in and out of availability. It's a private label security. There's money going into these pools to lend out, and the monies leave those pools when they feel like they need to be more cautious in the market. Well, if there's a day, let's just say the one that I saw was the biggest hit to DSCR was during COVID. When COVID hit, we saw people with $30 million of funding supposed to happen in 1 month, all cut off at once.
God. Yeah.
They weren't able to fund DSCRs at all for like 6 months. So what I tell people is use the hell out of DSCR. Set up your entities, buy with your LLCs, structure it properly. If you don't know what proper structuring is, that's where I spend time on the phone with people and really detail these things out. Then once we get that structured right, use that to purchase with that. And if for some reason something happens to the market that gets those private label securities to button up and they don't start funding, we flip you right to our conventional and we keep moving.
Yeah.
Right. So, and again, we have to make sure you qualify for conventional. DSCR is awesome because you don't have to qualify. You just have to have good credit and have to have the assets, and the property has to pay for itself. If it can do that, we can close loans.
Yeah. Got it. Love that. And I think a big thing there as well is, investors ask me all the time, like, well, what's the next step? Right. I'm on the phone with you, Nate. Like, what do I need to do? I said, well, step one, we're going to continue our education, but we need to figure out what we're going to buy, right? Like a good real estate agent. I remember back in the day when we were getting ready to buy my first house, a good real estate agent would be like, are you qualified yet? What are you buying? Right? Like a good agent, like an agent that knows what they're doing wants to know, like, well, what can you qualify for as a home buyer or an investor? And you're, in this case, an investor, right? So step one is always, let's see what we can actually get approved for. You might have $200,000 in the bank, but if you've got no income, but you got collateral, then there's going to be a specific loan product that you need to get qualified for, right? So, and that's a huge piece. You kind of just hit on some basics there between the two, and the asset is, or the having the LLC in place is another one people ask a lot about, right? That's something you can educate them on.
To say, I think Aaron hit on it a lot, which is like, the lending piece, it's not just how do we get the money to pay for this, it's really needs to be part of the strategy itself. And that is the foundation for how you build and how you scale. And so bringing that in early, not after you've signed the contract for the property, is really such an important piece of this, and making sure you're prepared for that.
Well, in picking the right lender, not in what's your price, it's how are you going to help us grow our business? So what's interesting is we all get shocked. Well, this other guy claims he can do the rate at X. Well, yeah, but where's that guy at? What does he do? What's his background? He's been doing this industry for 3 years. Do you really want to go into a deal that could be a financially beneficial for your family, or financially devastating for your family, where somebody has a 3-year history in the industry that's not going to look around corners for you and see what potential risks are there? He's going to tell you close, because he's got to pay his bills that month, right? Your partnership has to be more than price. What I've seen for the most part in my world, commonly, the most common might be an 8.25% interest rate. Well, what's our common price point? $200,000. So when you're talking about $160,000 loan on an 80% loan to value, you're talking maybe $8 to $9, maybe $10 a month difference. If you could pay $10 a month as a retainer for an expert in the field that's been doing it for almost 30 years, that has had ownership interest in almost 200 doors himself, that whose business has failed and recovered, and has coached thousands of people to be successful in real estate, would you pay $10 a month to be able to tap into that skull and everybody on his team? Or would you rather save that $10 and deal with somebody who has never even invested in a property but just has a great website and get it cheap? And it's not that cheap.
Excellent point, man. Excellent point. Going back to some mechanical stuff here, just so we can talk about some differences in between like conventional DSCR loans, things like that. Can you give us maybe an outline, like when someone's getting pre-approved with you, and we'll start with conventional financing, how do you define that? And what are the mechanics of a conventional loan? People say, oh, it's backed by Fannie Mae and Freddie Mac, things like that. What's the typical down payment? What's the qualification process look like for that?
The main thing is going to be income qualification. That's going to be your main difference. We're going to need your tax returns. We're going to need your pay stubs. We're going to need your W-2s. We're going to need your K-1s, your 1099s. However you're paid, we're going to have to gather all the documentable evidence from a taxable perspective to show what your income is and why you fit the qualifying for that particular financing. We got to prove beyond any shadow of a doubt what your income is, what you've declared to the IRS, how much you pay taxes on, and then apply that to what is your monthly expenses as far as reoccurring expenses, your housing, whether you're renting or whether you're making payments on a mortgage, your autos, if you have a financing on your autos, what's your credit cards monthly reoccurring, those kind of things. We figure out what are those monthly recurring debts.
Yeah.
We can calculate that into your verifiable income. We figure out how much is left over to be able to buy an investment property. Now, if you're buying an investment property that has a renter, we can use that to offset the expense, right? So that's possible. So now, because you don't have a history of owning rentals, potentially, or enough history to be able to count the rents as income, we count at least to offset. So if you buy a property that pays for itself, it's not increasing your debt to income ratio. But the question is does your debt to income ratio work for what you declare to the U.S. government? Now, because of very, very, very good accounting from very creative ways of running a business, you could show that you're at a negative income, but you still be able to live properly. People say, well, it's just taxes. It's what we do when we structure things. I'm like, I still have to go by what the bottom line says. I don't have a choice in that. That's one of the reasons I love the DSCR product. The other thing about your conventional loan is you have to qualify personally. You have to personally go on the deal. You are the buyer, period. As a real estate investor, what we have found is there's ways to structure your entities to be, and this is how I do it. I'll just tell you how Aaron Chapman does it. I have an LLC in every state that I'm going to purchase the property, and I make that LLC for that specific property. So it's a single member LLC. The member of that LLC is my Wyoming holding company, another LLC. So my, let's just say it's a Missouri LLC. I'm actually doing one right now, closing on a property in Missouri, is going to go on contract for that property. The signing entity for that LLC that buys it is a Wyoming holding company. Well, who are the members of the Wyoming holding company? It's a living revocable trust, which is my family trust, and I'm the trustee and my wife is trustee. We go on there on the loan documents as the borrower, myself and my spouse. Sometimes, a lot of times she doesn't, just myself, as the legal signer for the trust. And then we have all the paperwork, obviously the formation articles. You've got the EIN and SS4 document, and you have your operating agreement for the entity buying the house, for the LLC that's the owner of that entity that's buying the house, which is your holding company, and then I have to have my trust docs to show that I'm signing, and then I sign a personal guarantee. What I love about that structure is it separates me personally from the home significantly. That house has to stand on its own because the entity if there's any legal issues, has to do with just the entity in the house, not Aaron Chapman as a person. So I have enough gap there. At least that's the plan, right? Doesn't mean people can't spend a lot of money and chase you down. It still can happen. Also, I get to take title in the LLC right out of the gate. Never touches my name.
Yep.
I get to set up an account in the LLC. It goes through that, and then of course payments come out of it. So it keeps it completely separate from me. You can't do that on a Fannie Freddie loan. I can do that with DSCR. And in my career of doing this for almost 30 years, one of the biggest questions I had for real estate investors: why can't I buy this with my LLC? Why can't I do this? Just me with a little bit of a layer of protection. It's like me putting on a parka, going out into the snow to build a snowman, right? It's still me doing it. I get it, but we couldn't do that for the longest time. Now we can. So when people ask me, which should I do? Conventional? Is it a better interest rate? Who gives a damn about the rate? You now get to have what people have been begging for forever.
Yep.
I won't call it the Holy Grail, but I'd say it's its first cousin. You get to get a 30-year fixed mortgage to an entity.
Correct.
And most of the time, they don't even report to your credit. So if you've got stacking entities, right, an entity in Missouri or multiple entities in Missouri, multiple in Arizona, multiple in Tennessee, multiple in Alabama where you're buying houses, right, and they're not showing up on your credit, and then those things, that type of lending goes away, and now you have to buy properties through Fannie Freddie, and Fannie Freddie asks, how many finance properties do you have in your name? None. I have none, so I can do 10 more with Fannie and Freddie, right? So it's a matter of how you structure it. And that's a structure we work through with people constantly. I've got a law firm that works in all 50 states that give my clients a significant deal to work with them. Instead of paying $1,000, $1,500 per LLC, it's a flat retainer, $3,680, and you never pay them again, and they'll do unlimited LLCs in the United States for you. We will build your business all the way to bedrock. And I've been negotiating those things for my clients for decades.
Nice.
It's epic.
It's freaking huge, right?
Yeah.
It's not just somebody doing paperwork. It's also, you've got people you can call and talk to about your entity structure, right?
Yep.
So I am really, one of the things that's different about us, I'd say, versus any other lender out there, we are extremely heavily focused on the next two generations. How do I take the person sitting in front of me right now to help them to start building so their kids and their grandkids have a shot at it? And why am I focused on that? Because if I focus for myself, I stare at my little grandkids. I got 3 of them. I'm like, you don't have a chance in this world if I don't change everything for you going into it. So I'm literally selling a lot of my assets in Arizona. I'm moving everything to Missouri because we can control a lot more there. I've got land there, and I can graze all my kids and grandkids and cousins, and all of them can be right there, and I can watch them. I can be part of their lives and then participate in the business structure of the family trust, and we all get to do these things together. Why would you not want that, right? It's amazing to me to see what happens to a family when they're scattered versus when they're really, really close. And I'll be damned if something happens where they don't get to know who their grandparents are or their cousins are. I grew up in an area where we had to move around a lot. I didn't know my grandparents that well. I definitely didn't know my cousins that well from after 7, 8 years old. I'm not going to let that happen to my kids. And I want to make sure that anybody who wants to do that has somebody in their corner to help you structure everything possible to be able to finance all that. And what people need to understand, financing is not debt. This is actually the greatest wealth creator in the deal when you're buying investment real estate.
100%.
Is the financing piece. People think I get more cash when I pay cash. But your returns are so small when you pay cash. You have so much invested, but so little coming back. When you invest little and leverage a lot, your returns are huge, comparatively speaking.
Yep. And so a couple things I'm hearing there, man, is just obviously legacy is huge for you, right? Leaving a legacy, growing with your family and growing with your grandkids and with your kids is huge. And it's I like how you tied the lending piece into that, right? It does matter. It matters how you structure it, and if you have the right asset protection in place with the trusts. There's a couple of questions we have on conventional loans, but I feel like you already answered those, and we can kind of scoot right into DSCR here, kind of explaining that. You'd mentioned obviously, having your structure, having LLCs in place, having the Wyoming LLC, make that be the obviously the beneficiary of those subsequent LLCs, in those states. When it comes to working with a client and the option we hear about is the DSCR loan, the debt service coverage ratio loan. How do you explain that product to them? Because a lot of people don't even know what DSCR means, right? Can you give us the definition and what that means? And so it doesn't sound so daunting. What's this DSCR piece mean?
Yes, definitely. Because I remember when I first heard that, I'm like, what the hell does that mean? And somebody told me it's debt service coverage ratio, and I had to put it together in my head, what that means. The simple way of explaining it is, does the property pay the payment or does it not? So it's kind of another way of underwriting your deal. If you're buying a house that the payment is not enough to pay the principal, interest, taxes, and insurance, then why are you buying the home, right? DSCR is basically saying if you buy a property that generates enough gross rents, let's say the rents are $1,200 a month, and the payment on the house is between the principal, the interest, the taxes, and insurance is $1,200 or less, we can fund that loan. Now, we can do it when it's $1,200 payment and it's like $1,150. Now you're at a little bit of a negative DSCR, like 0.9 something or 0.8 something. That's doable, but your rate goes up, your costs go up, and it's prohibitive, right? So what's funny about that is you're at a 0.99 DSCR, and now your rate went up because of that. So now you're at like a 0.95 because the rate went up and pushed your costs up. So it forces you to target properties that will cash flow enough to pay for themselves. And that's ultimately what we want. And a lot of people say, well, I'm going to target things that cash flow at least 15, 18% annual cash on cash return. Well, that's going to be harder and harder to find. It's possible. You might have to put more money down to accomplish that. Well, that's more money you're putting into the deal. That means it has to cash flow more to warrant the amount you're putting into it. And that's a whole other separate conversation. We can get into at a different time. But ultimately, it's just saying it's more or less buy properties that pay for themselves. That's it. If you have to go to your pocket, to me, it's not a good DSCR deal.
Got it, man. Love that. And that actually just hit on something there about like what happens if the property doesn't cover. It's interesting. I've never heard that. So you actually can do a DSCR loan if it doesn't cover like the 1.2% you need for the coverage ratio. It sounds like the
Yeah, we
rate
can
just goes up.
I think if we go as little as 0.85 or 0.9 or something like that, we just steer away from it because all of a sudden you're
Yeah,
jumping a 0.5% in rate.
right.
To me, it's not conducive. That's somebody who's just so emotionally hell bent on this house, right? And sometimes
Yep.
that's not the best thing to do is be emotionally tied to the home. And I'm kind of doing one of those right now. So I'm speaking from experience that we're closing on one right now because of what's going to bring to us for our future. But a 1-to-1 is what our target is. And I always price
Okay.
everything 1-to-1, that it's going to rent for exactly what the payment is. That's a 1-to-1 ratio.
Perfect.
If the higher the rent is, the better the ratio becomes, right? Comparatively speaking. 1.2 is the most common one out there. People say you got to have a 1.2. Our targeted sources will do a 1-to-1.
And so what that means out there, guys, is like if you have, as long as the rents cover the principal and interest PITI payment, right? You're good to go. It's 1-to-1. And then most of the time you're going to rent enough to where it's going to be 1.2 times that payment, right? So
Exactly. So a good way to figure that out is you just you take the total rents and divide the total cost to it, and you'll get your ratio. So if you got a $1,200 a month rent and a $1,000 a month payment, that's a 1.2 ratio.
yeah,
That's the target you're seeking. Now, if I get a 1-to-1, we're good. 1,000 and 1,000 works for us.
got it. Do you see differences in interest rates right now in conventional versus DSCR? Which is interesting. They're pretty close now, right?
Conventional is slightly higher presently, which is really interesting to consider. So you have, traditionally it's going to be the other way around because people think, well, this qualifying is a little bit looser, so wouldn't it be a higher interest rate? Well, when you start figuring out where rates come from, it starts to make sense why they're lower. So, and we may not want to get too deep into this, but interest rates come from the supply and demand of money. It's not the Fed. It was the Fed during quantitative easing, 2009 to 2021. There was $16 trillion shoved into the markets to bring those rates down. Those are unnatural interest rates. For people wait to come again, you're holding your breath, right? But so what we're talking about here is the supply of capital going into the mortgage-backed securities. And if you want to know what a mortgage-backed security is, go watch the movie The Big Short. They talk about that right at the very beginning. Lou Ranieri from Solomon Brothers created this thing. So hedge funds, pension funds, mutual funds can put capital into this and get a flat rate of return. When they shove money into a bond like that, a long-term 30-year bond, they're expecting a rate of return from the interest collected, and it's secured by the real estate that they lent it on. That's basically how that all works out. Now we have another pool, these private label securities, where they can invest to lend out strictly based upon DSCR guidelines. And with that type of deal, there's not as much draw on those pools as there are on the conventional pools. Your conventional pools have people buying houses to live in, second homes, investment properties, a bigger population pooling on that from the conventional loan. When you're talking about DSCRs, they're not as prevalent out there in the marketplace, not as many people drawing on them. So even though there might not be as much money going into those pools, there's less money coming out, comparatively speaking. So as a result of the supply versus the demand, those rates are actually cheaper right now. Another thing that makes them cheaper is because you're getting 5-year prepayment penalties. That is saying that you're going to stay in this house for 5 years or retain this property for 5 years. You're not going to pay it off any faster than the amortized loan, and you're not going to sell it or refinance it during that window of time, or you're going to pay a percentage penalty. Now, most of the ones we do are either fixed or declining prepays, meaning if it's fixed, that's 5% of the outstanding balance for the first 5 years of the loan. If you pay it off or pay it early, that's how it's going to be, or try and sell it. If it's a declining prepay, that means for the first year, it's 5%. Second year, it's 4%. Third year, it's 3%. The fourth year, it's 2%. Fifth year, it's 1%. And then it goes away. Now, the reason they have these on here, when you consider the Fannie Freddie loans, Fannie and Freddie are not necessarily lenders per se. They're guarantors. They will buy blocks of loans, but also guarantee it. They wrote the guidelines. They produced the guidelines. They said if you, as the lenders out there, the Wells Fargo's, the Bank of America's, the Chases, and all the other secondary people on Wall Street, if you fund these loans based upon this criteria and you lose money, we'll indemnify you to get you whole. So if you have to foreclose because you lent based upon what we said was acceptable, and then you lost money in that foreclosure, we'll pay you the difference between what you lent out and what you lost. So that's how they're protected. That's why they can offer the rates they do. Now, when you get into the DSCR world, right, to say we don't have that protection. We're making it up as we go. These are business purpose loans. So what we're going to do is we're going to charge you a prepayment penalty. Now you're going to get our best rate at 5 years. If you want a lower prepay, it's going to cost you. You're going to charge you more money or raise your interest rate. But they need to get some sort of return on investment, because if something happens and they lose, and here's just to understand, anybody who lends money out on a 30-year fixed mortgage, they don't start making money till about year 4. Because when they close on that loan, they have to get it audited, they have to get it rated, they have to get it securitized and set up servicing. That's not free. You got to pay people to do those things. By the time it's done, it could be about $4,000 a transaction. Well, if you're only making payments to them of say $1,200-$1,300 a month, and the interest on those is really not that much, look at how long it takes to be able to make that money back.
Sure.
It could be 3-4 years before they start breaking even, because they're also paying people on a monthly basis to do the work that they're doing on top of that. So just because you start making a payment back to them doesn't mean that they're capitalized yet.
Got it. Real quick, just one question before we jump on our next talking point here. When you're talking about these prepayments, now can clients and investors make extra principal payments to accelerate the pay down on that loan?
If they've accelerated that payment and paid the balance down for a percentage below where they should have been on their amortization table, they can get hit for a percentage of that.
Interesting.
Okay. Yeah, so it's not going to be full balls prepay. They'll get to say, if you knocked it down by an extra 1,000, they might hit you for 5% of that 1,000.
Okay, got it. Good to know. And would you say all DSCR lenders are doing prepays right now, or just some different? Okay.
Everyone that I've worked with is doing a prepayment penalty. And let's just be blunt. Why the hell would you want to refinance or sell within the first 5 years anyway?
Correct.
There's no state investment deal that's really going to do for you what it should within the first 5 years. The first 5 years is really getting your business established before it starts to compound and grow. Right? So just tell everybody, if you don't feel like you can stay in the deal for 5 years, well, if you're not doing just a straight up flip and you're going to do a long-term loan, why are you buying the property? It doesn't make any sense. Yeah. And if you're saying, I want to refinance in the first couple of years, why? Why would you refinance? If you can't pull cash out, there's absolutely no justifiable reason to refinance. The only justifiable reason might be if you're getting it today at, say, 6.99% interest rate on a 30-year fixed, and all of a sudden, because the government decided to pull all this money back out and screw us as an economy and do quantitative easing again and do it down to 2%, then okay, fine. Do the 2% rate just so you can put that on your headstone and say, I got 2%, I won. That's the only reason. Outside of that, there's absolutely no reason to do a refinance in the first 5 years.
I think it's hugely insightful, of course.
Man, you guys covered a lot. I mean, I think maybe not so much a question as there's a reiteration, right? When specifically real estate investors, they're starting this journey or maybe a couple deals in, right? Their focus is always on building their team. And for some reason, that team just is like, got to find the right contractor, got to find the right real estate agent, right? Got to find the right inspector and the right appraiser. What they never think about is the lender. And yes, they think about it as that'll happen when the renovation is done, or that'll happen once it's rented and stabilized and it's with the property manager, right? When realistically, that thought process needs to be when you're analyzing the deal. Right. Teams like Aaron have the opportunity to come to you and say, hey, I agree with your ARV, or I agree with your debt service ratio number for matching DSCR if we have to go that route. Right. So having them look up front provides you this opportunity to say, hey, we're pretty much looking at this deal from every angle, right? The construction checks out, the rents check out, but also the financing and the back end checks out. And we're not in a position where 3 months down the road, everything went great and, oh crap, the financing doesn't work anymore, right? So, that's huge to remember, and leaning on someone like Aaron's team is going to be massive.
Well, and to that point, markets move a lot. Interest rates move consistently and constantly. And if you need a specific rate to make the deal, you don't have a deal. Exactly. So it's amazing how people get so locked into pro forma and their cash on cash that's everything is that pro forma. I'll just be blunt, guys. As much as Nate and John and team want to get you as good a pro forma as possible, pro forma is, in my opinion, an old Greek word for bullshit. It's the best that they can come up with for something that is yet to be proven.
Yeah.
Because it's all best guesses is all it is. And the market shifts, the taxes shift, laws shift, tenants shift, the demand in areas shift. So I tell everybody, what you need to be focused on as a real estate investor is, what can I buy? I can keep it reasonably rented the entire time I own it. I can raise rents, and I can reasonably believe that it will appreciate at least 2 to 2.5% per year. That's it. If you get that, you win. You truly win. You can see at a 20% down, you can see 30+% returns every single year if you know the math and you know what you're getting a property like that. But if you are so focused on, I got to get this house that has this massive cash on cash return, and you ignore all the other things, you spend all your so-called cash on cash or your so-called return in cash flow on keeping the house up, because all the other fundamentals were not addressed, were not looked at. And now you got to maintain this thing that is difficult to maintain, and you need every bit of cash flow to do it. You don't win at all.
Yeah.
So you have to really understand everything. And the only way to understand it is people like who we're talking to here that do this professionally. And myself, who's been looking at this for 30 years. I watch investors implode because they're looking at the wrong things.
Yep. Chasing cash on cash return is the story.
I was just going to say, with all that, Aaron, and this is actually more probably a question for Nate, is because this plan building and bringing in the lender is so important as part of this overall strategy, on the TKPP side, when do we pull Aaron into these conversations with our clients? Or when should people who are looking at turnkey, when should they be reaching out to a lender?
As soon as possible. Like, I literally get people to the lender. Like, if we're having a conversation with someone who wants to invest and build a portfolio, I'm introducing people to Aaron and lenders on the very front end of the process, right? Again, we have to know, one, what we can qualify for. Can we qualify for the average purchase price, right? Do we have the credit to get a decent rate on a DSCR loan, or do we want to pull out all these documents together to get a conventional loan, right? So to me, step one of any investment plan, besides the education and plan building and talking to us and building a strategy, is getting pre-approved, right? And that's including, like, when we're doing BRRRR model real estate. When we have clients that are picking up BRRRR rental properties that aren't even going to use the refinancing a DSCR loan for 4, 5, 6 months, we'll get them to Aaron. So Aaron can sit down with them and go, hey, great, you're going to be buying a BRRRR property. You're going to close cash, and then in 4, 5, 6 months, when the rehab is done, you're going to refinance. I want them talking to Aaron as early as possible, right? And I think, Aaron, you can attest to that, right?
Honestly, ridiculously important that even the BRRRR deal where I'm sitting on $200,000, I'll just pay cash for the houses. We need to talk long before they even find the house. That's an absolute necessity, because how you buy it will determine whether your money is locked up for 6 months to a year, or you can get it right back out and do it again. The reason you do BRRRR is so you can get assets in your portfolio and get as much money back in your pocket as possible to do it again. You're creating an engine. What good is an engine if you haven't properly fueled it? It's not going to run. You're going to have it just sitting. You can have the biggest hot rod in the world, but you have zero gas in the tank. You can't do anything because you spent all your money. You can't buy the gas. We need to set you up where you get that right back in to put gas in the tank and keep that engine moving. And it's important that we talk up front. BRRRR more than anything. You can screw yourself all the way through a conventional deal and still be able to get to that closing table, but a BRRRR will lock you up, and lock you up hard if you do it wrong. And I have spent an enormous amount of time and energy unscrewing somebody from their own mistakes when it comes to BRRRR. And if we just talk up front, and I'll give everybody the once over. It takes me 45 minutes in a conversation with a person to get them set up properly and get their mindset in the right place. So I've got to carve out a lot of misleading information or park the right stuff in there. But then I say, listen, your notes are not, you're going to be your resource. I'm your resource. So what you do is you go to this step and stop and call me, or set up a call, and we'll talk again to the next step. The first couple of BRRRRs, I walk them step by step. I'm practically holding their hand through the whole thing. Because if they screw that up, their deal's locked up. And you guys can't afford to have that locked up like that. I can't, and they sure as heck can't. So to Nate's point, and to the question, you pull Aaron Chapman into the deal as soon as they get done talking to you and say, I'm interested in real estate. We jump in right at the very beginning, because if they're not set up properly, you guys have now taken a potential client that could buy 12 and lock them into one, and they may not buy another one ever again. And I'm not saying we're the end all be all. I'm not saying there's nobody out there that can do what we do. I'm just saying there's not very many that do. And they're so interested in just, you want to buy a house? Well, here's my rate. We're going to close. It doesn't help everybody to be able to just close on deals. We need them to structure it well enough where they can reach their goals, and probably reach them a lot faster than they thought, just because now they know how to do it.
For someone who is looking at their financing options, maybe wants to get in touch with you, like, can you walk us through a little bit of like, what does working with you actually look like? What's the best way for someone to get started?
Well, first off, it's usually going to be a connection from John or Nate or another member of the team, be an email or a text. And then what we do is I have my assistant Bree set that up. Now, I'm not a Calendly guy. I don't like Calendly. When somebody sends me their Calendly, I'm like, I don't want to go through your calendar. I don't have time for that. And then secondly, it's like, it's been so many of those Calendly setups that changed. So I have Bree, my assistant, will personally sync our calendar to make sure I can block the whole world and focus on that one thing. Working on the upfront conversation, to me, is probably the most important conversation of the whole deal, to make sure that we're aligned properly. Because if I just take an application and go, we may not be the right fit for these folks. We want to make sure we're the right fit and they're the right fit for us. So I spend an enormous amount of time up front. So it's a plan for a 45-minute conversation. Plan for me to take you through some math discussion to make sure you're seeing things properly. I'm going to make you do math in that call. And then we're going to figure out what your goals are, where we're heading, and how you want to structure, introduce you to the people you need to help get that structure right. And then it's going to be, okay, now let's do the application. Let's make sure you're set up properly. My team will take you through an extensive underwriting process up front. When you don't even have a house yet, we're going to do this when the stakes are small, right? And make sure that we know exactly we can get this deal done. We send a letter that says you're qualified, even if it's a BRRRR or a purchase, no matter what it is. We want you to know that we've taken the time to have an underwriter look at this, and we feel very confident that we can get this done with little issues, right? Doesn't mean that things aren't going to pop up. There's humans involved, stuff happens. Well, then from there, once that letter's in there, you start looking at finding a property. You find something you like, we set up another call, and we start talking about how that structure is going to go. If it's a BRRRR, we have to set it up properly with the right entity structure. I would advise you have that entity conversation call with the law firm we're connected up with right out of the gate as well. Start knowing what you need. Set up your Wyoming holding company right out of the gate. And then you can start setting up the entities in whatever places you're going to buy that will go to that holding company. And then it's just take the deal. Once the deal comes in, we guide you through it, get it closed, set it aside. Where's the next deal? And some people say, can you do 2 or 3 at once? Yeah, we can. I've done as many as 10 transactions for one client in 3 different states that closed on the same day. Most miserable shit we've ever had to do, but we'll do it.
But
I don't recommend it, but we'll do it.
Love it. Love it. So we'll make the introduction. We'll get started as soon as possible, whether it's a BRRRR or just a standard purchase there. And we'll let you run with it, man.
That's
We're
all
going to educate him.
Run with it and get people pointed in the right direction. And that you guys I want you guys to feel confident and comfortable that part's done. So you guys worry about finding the deals that work for them in the real estate side. Yeah. Let us make sure that they're very bankable. The problem with a lot of law firms I found out there, they come up with really trick stuff, right? We're going to give you the great big Jeff Bezos special that's designed to protect your castle on an island, but it's not great. Forgive me, but for St. Louis shitbox, you don't need it for that. But we can build into that. So what we do is we help them structure in a way that you can build to those points, but you don't need it right now. You do that stuff, you're not even lendable. You can't use land trust. You can't use real estate anonymity trust. You have to do specific entities to be lendable. And right now the goal is leverage and bankability. If you don't have that, you're going to your pocket for everything. And then you can't create wealth that way. You can create cash flow. You can't create wealth. Cash flow pays the bills. Wealth is what you pass on to the next generation.
If someone's 6 months away from buying their first investment property, what's like the one thing they should be doing now that most investors just wait way too long to do on the finance side?
Do the application immediately, even if it's 6 months out. Let's see if there's anything that's going to prevent you from getting financing. We're not going to pull credit. We'll do a soft credit pull so we can still at least look at the credit and know what we're dealing with. But let's lay the foundation. Let's start digging that to bedrock. If you're going to start buying in 6 months, you say, I am hell-bent on making this happen. Okay, let's look at the financing capability. Let's start your entity structures. Let's look at where your capital is. If you're sitting on a couple $100,000 in capital, what have you done to protect your family outside of trying to build something? Have you looked at the infinite banking strategy? Have you considered whole life insurance? That's another thing that I have. All my money goes to whole life policies first, and then I use that to buy investment real estate. In 2008, I got in a motorcycle accident August 8th of 2008. I shouldn't have woke up from that. I was doing 80 plus miles an hour. I got pushed into another car heading down the Arizona freeway. And I don't know if you ever lay down in Arizona in August on the pavement. It's not the best time to lay down on the blacktop. But I came back from that and lost everything. I went from a net worth of nearly 4 million to a negative net worth of 1.5. That could have happened to my family if that would have happened either way. But if my life was taken from me, what would I have left my family at that point? Now, that changed for me exactly what my plans were. Now that I have these whole life policies I can borrow the money against, use it just like it's come from my bank account. Sure, I can build my bank accounts up and do it that way. But if something happened to me, my family gets an empty bank account and real estate. But now that I've parked it in the whole life first, and if something happens to me, now they get this monster death benefit plus all the assets that we purchased. They get double, right? So there's things that we need to go into depth with folks. And the earlier we can talk, the better. Get that foundation set to protect you, protect your family, protect the name that you're building, and protect your grandkids and your great grandkids. Because if we don't do that, nobody else will.
There's no harm in going through the pre-approval process. I always tell investors, like, I know we're early on in the process here. I said, let's work on the pre-approval. Regardless, doesn't mean you're going out and you're buying something tomorrow, but you're building the foundation, right? We know what you can do. So, you can be super excited to go out and buy investment properties, but you're out of luck if you don't know what you can do.
Yeah, all the excitement in the world doesn't do you any good if you can't get there. I had a client call me yesterday that she's can't wait to close on something, but unfortunately, interestingly enough, she's got the assets, she's got the drive, she's got a credit scenario we just can't get past, right? Yep. So we have to adapt and put a husband involved, right? But earlier you get the problem is she's like on an impending closing in a week. I'm like, we should have talked a long time ago, right? So we need to be doing these things well in advance to find out what problems we might have to overcome, and things are overcomable if we have plenty of time to work on it. It's when you start putting everybody to a final thing that absolutely has to happen. It doesn't work so well.
Yeah,
I think that really kind of sums up this episode for me, right? Financing is one of the things that people they think, oh, it's simple. I'll just go get a loan. I've got a property now, right? But it really can get complicated fast. There's structure that needs to be in place, strategy that needs to be decided on. And so going and understanding your options before you ever need them, that's really how, as an investor, you're going to build a solid foundation. You're going to be able to scale. And like you keep touching on, Aaron, be able to protect those investments for the future. Yeah. So as much as possible, get on the phone with someone like Aaron as soon as possible.
Yep. And you have to have the right mindset. You have to have the grit. You have to have the team. There's so many things that are an absolute necessity. I'm going to finish off one thing, and you got to go get this. Go get the book, Red in Economics. I put this thing out. It started, I think it got released in January of this year. It was a forward by Robert Allen. A lot of investors on here, you probably know who Robert Allen is. He's the OG of investment real estate. People know who Robert Kiyosaki is. That's the theories guy. Robert Allen's the practical application guy. He's the one who convinced me to write the book. It also has an afterword by Dolph DeRoos, another badass in investment real estate. Both these guys, afterword forward. If you want the audio version, the audio was done by me. Robert read his forward, Dolph read his afterward. I read the book itself. It was the hardest damn thing I've done in a long time, is my own stuff. But if you get it and it's worthy of 5 stars, please put it on there and let me know you did. I'm getting 83 books sent out with my signature. There's $100,000 in artwork in this thing too. The artist's signature, Robert's signature, and Dolph's signature on 83 books that will be distributed only to 5-star reviewers. I said, if it doesn't earn 5 stars, just tell me why it didn't. Don't put 2 up on there. Just tell me why it didn't.
All right. Awesome. Well, thank you so much, Aaron, for being here and for sharing your insights with us. We really, really appreciate it. And thank you, Nate and John, as always. We'll see you guys in the next one.
All right.
Thanks, guys.
Thank you, Aaron. Take care, guys.
Thank you.